Hey, good afternoon once again, Market Rebels, and thanks for making it back to Trading Tune-Up. We do this every Thursday I'm sorry, excuse me, it's been canceled because we do Coach's Corner then. It's on Monday, 4 p.m. Eastern Time. But a little bit of a fizzle in the rally today, kind of disappointing, but still a little bit of a surprise after all of the run-up that we had last week. So hopefully we're going to see a little rally throughout the week. Not much in the way of economic indicators. We have retail sales, jobless claims coming out on Wednesday and Thursday, respectively, at 8:30 in the morning Eastern Time. So again, unless we get any really big information, it should give us a fairly clear path for a rally. But it looks like we closed, I didn't see the actual close, but maybe just about flat, maybe slightly down, but not too bad considering last week's rally. So with that, let's take a look at today's topic with all this volatility. One of my, I think, favorite topics in here when it comes to options pricing and models is parameter Greeks. So what are parameter Greeks? Now, most of you have heard about the Greeks, but which of them are what we would call parameter Greeks, and why are they important? So again, the Greeks are, now there's lots of them, there's really 5 key ones that we use for general purposes when we're talking about our Greeks. Remember, these are outputs from a pricing model. That's where these things come from. There's delta, which shows us the sensitivity in options price to changes in the stock's price. We have gamma, which shows us the sensitivity of delta in relation to the stock's price. We have theta, that's our time decay. Vega, which is the sensitivity to volatility, that's where the V comes from. And then we have rho, which is the sensitivity to interest rates, which is where the R comes from. So out of all of these, those two right there at the bottom, Vega and rho, are what are called parameter Greeks. And it might be a term that you probably haven't heard that much, but what are parameter Greeks and why are they important? Well, let's back up and find out what a parameter is. It really comes from math. It's just a number that defines a system or sets the conditions of its operation. And so too many times traders, I think, focus on delta, gamma, theta, of course, a big one that they focus on, but they kind of overlook Vega and rho, and especially in this rising interest rate environment. So yes, the stock price technically is variable, but it's actually known at any moment. Just look at your broker's platform. You can see where the stock is trading. Time is also variable, but it's also known at any given moment. We know that in 30 days from now, that 30 days are going to pass. So even though those are inputs to the model, the stock and the time, they're not really super important because they just depend on the number that you give it. They're not really the parameters that are defining the model. But Vega and rho are perhaps more important for risk management than delta and gamma. And again, this kind of surprises traders. We spend a lot of time talking about delta, gamma, and even theta, but you could certainly make a very strong argument that Vega and rho are the ones that you need to keep your eyes on. Why is that? Well, delta and gamma are also extremely precise. Remember, they're outputs from a pricing model, but that's assuming that you have interest in volatility correct. See, the reverse doesn't work. You don't input delta and gamma. They're outputs. But really the true inputs that define the system, and when I say the system, I'm talking about this pricing model, are Vega and rho, volatility and the interest rate. So why is that important to understand for these markets? Well, a lot of people like to trade leaps options, which are your long-term options, more than almost 3 years out into the future, just long-dated options. Leaps are available on all optionable stocks. Those are the ones that have options traded on them. That is assuming they have an average daily volume of 1,000 contracts. So most of your big name stocks are going to have leaps on them. But because of their longer term, they're far more sensitive to Vega and rho. So even though sometimes we just say, leaps are really the same thing as a regular option, they're just longer dated, partly true, but because of those longer dates, it really opens up the doors to a lot of fascinating strategies and also risks that traders aren't familiar with. But notice that those two, Vega and rho, are your parameter Greeks, and those are the two that they're most sensitive to. Now, another little interesting tidbit about leaps is that they're harder to price, and that can actually be a benefit for you. And it's because of the longer expirations. Volatility and interest rates become bigger unknowns. right? The Black-Scholes model assumes that volatility and interest rates stay constant through the option's life. The fact that they don't is what gives us our skew in the markets. But the model assumes that they're going to stay constant. And really, in a short term, let's say over 30 or 60 days, that's probably a pretty good guess. It's not going to make, in most cases, not going to make a big change. But you let those things go out 2 years or 3 years, you're far more likely to experience what we call these black swan events, extremely rare things that nobody saw coming, that were either considered impossible or extremely unlikely or just completely unknown. Or it could be other major events over, let's say, a 3-year period compared to something short like 30 days. So this is where some of these risks and benefits can creep in with longer dated options. So the first thing you have to understand to make better decisions is that your longer dated options, LEAPs, are going to have a greater exposure to volatility. So let's take a look at $200 calls. One has 30 days to expiration, and another has, we'll give it 2 years, 720 days to expiration. And the question we want to find out is, how will these options behave as volatility rises? Well, let's put them on a graph. On the horizontal, we have different volatilities, 10% over here at the far left, 60% on the far right. On the vertical, we have option prices. So I think these were priced at about 3% interest, but it doesn't really matter. It's just some inputs to a pricing model. But the point is, take a look at how flat that line is for the 30-day. It's relatively flat, at least compared to the red, which is very steep. The black line is the 30-day option. The red one is the 720-day. So if we were to put this into a pricing model at 10% over here at the far left, the 30-day option would be trading for $1.14. If volatility pumps up to 60, remember that's still assuming there's 30 days on the clock, it would be trading for $6.85 or a 500% increase. All right, let's do the same thing for the 720-day. It's priced at $5.60. If volatility is 60%, it's priced at $32.65, 483% increase. Notice those percentages are about the same, but look at the slope on the red. Now, this is also where there's a little bit of a misconception about volatility and why the longer dated options are more sensitive. So take a look over here. If we compare $5.60 to $1.14, it's roughly a 5-fold increase. Look at the prices over here. 32 compared to 6, roughly 5-fold. So it's really just because you're pricing the option at 10% versus at 60%, it's still being fed into the same model. And so that pricing relationship is going to just hold basically constant. So another way you could look at this, if you bought 5 contracts of the 30-day, you would get exactly the same response, at least over 30 days, as the red line. So is it really fair to say that the longer dated options are more sensitive to volatility? It depends on how you look at it, but it's really because they're just more expensive. And that's why this line is pretty much a straight line when we measure it in terms of volatility. So yes, if you get in a rising volatility environment, calls and puts are going to benefit for sure. Longer dated ones are going to increase in dollar terms a lot more. But if volatility is falling, you're riding the slope the other way down. Okay, that can really hurt you on a LEAPS option. Now, what about the interest rate? LEAPS give you greater exposure to interest rates. So during periods of rising interest rates, the calls will gain value, but the puts will lose. And a lot of traders get this one wrong as well. They just say, oh, options increase in value during rising interest rates. And it's because a lot of times traders trade calls, usually easier to conceptualize stock going up than having the right to sell with a put option. And so they assume that this applies to puts. It doesn't. Puts are just as equally sensitive, but they're in the opposite direction. So remember that your LEAPs are far more sensitive to interest rates. So you got to keep this in mind if you have rising interest rates. So again, let's take a look at $200 calls. One is 30 days to expiration and one is 720. Volatility is 25%, interest rates at 3. So if we have the 30-day option, $100 call priced at $298, remember that's at 3%. Let's assume that interest rates rise 1% from 3 to 4. Look what happens to this option. It goes from $298 to $302. It's an increase of 4 cents or about 1.3%. Not really a big deal. But we look at the 720-day one priced at $16.59. Interest rates jack up 1%. Look what happens. It goes to $17.59. That's an increase of 92 cents or 5.6%. So they do have, again, more sensitivity, but it's partly, again, because they have more value. But that is something that we have to be aware of. So here's what we look like in terms of interest rates. These are interest rates on the horizontal, 1% at the left, 12% on the right. Look at the 720-day option in red. Much more sensitive than the 30-day here in black. And that makes sense. Think about it. If you had a credit card with whatever, 18% interest, and you've got a $3,000 balance for 2 days, it's just not going to make a difference. What if it had a 20% rate? Not going to make a difference. 25% rate. There's just not enough time for the interest to accrue. And that's a little bit about what's happening here. But when you have a longer dated option, big difference. All right, so in the black, we've got a price of $233 with an interest of 1%. If interest rates go to 12, that option goes to $286, an increase of 23%. Let's move to the 720-day one. It's priced at $12.06 at 1% interest. And out here at 12%, it increases. Look at that, 25.33, an increase of 110%. It's a big difference. So yes, it's a benefit for call options if interest rates are rising, but it can also be a negative if they're falling. Now, what about the put options? They're the opposite. They're going to take a huge landslide if interest rates rise. So again, we've got maybe $2.25 and it'll fall to $1.77, 21% decrease. But take a look at the 720-day one. It's going to go from $10.11 down to $2.33. It's going to lose 77% of its value. So you just have to be aware of these pricing relationships to make better decisions. Now, a little side note, a little caveat. Remember that interest rates, at least recently, it's kind of a different story, but they generally don't move in 100 basis point moves, right? I mean, we've been getting some 75s, but the thing is that normally they're in 25 basis point increments. So you have to say, even if you look at a pricing model and it says it's going to go up a certain amount by a 1% increase, it's probably going to take a while for the interest rates to do that, except in today's environment. But I just wanted to let you know that, what the parameter Greeks are. It's just to also show you there's a lot more to understand about Greeks, option pricing, and therefore strategies and decisions. So remember, if you want to increase your performance, take it to the next level, we'd like to extend a free 30-minute one-on-one assessment with one of our world-class coaches, which, by the way, this Thursday, we're going to have 2 of them on for you. We're going to have Stu, he's our regular, but we're also going to have Elliot Katz. Got a good topic for you, so if you can, join us 4 p.m. Eastern Time. But the phone number there is 888-809-8058. You can get yourself a free consultation. It will make a big difference in the way that you see options. So I hope that helps, gives you some things to think about, and we'll look for you Thursday. Thanks so much.